Welcome to the Riskwiser Zone, the podcast where we dive into the world of stocks and finance to help you make informed decisions about your investment. I'm your host, Louis, and I'll be guiding you through the latest news and trends that could impact your portfolio. Today, we're going to talk about small cap funds, specifically the Bantan Small Cap Fund, which has been making headlines recently. Now, before we dive into the details, let me just say that small cap funds can be a great way to add some diversification to your portfolio and potentially earn higher returns, but they also come with their own set of risks. According to recent reports, the Bantan Small Cap Fund has been performing well, with a trainer ratio of 1.96 and an alpha of 0.63 over the last 3 years. The fund has also shown a return due to net selectivity of 0.59, which is a good sign. However, it's always important to remember that past performance is not necessarily indicative of future results. The fund's investment style is focused on growth-oriented small-cap stocks, and it has a portfolio of 181 stocks as of February 28, 2025. The top 10 stocks in the fund constitute around 20% of the total portfolio, which is relatively diversified. The fund's managers, Manish Gunwani and Kirthi Jain, have been doing a good job of navigating the market volatility and finding opportunities for growth. However, as with any small cap fund, there are risks involved. The short-term outlook for small caps remains cautious, with market volatility, profit booking, and rich valuations putting some pressure on this segment. According to expert Sandeep Raithura, several small-cap stocks have already seen corrections of over 20%, 30% from their highs. So, what does this mean for investors? Well, if you're considering investing in the Bantan Small Cap Fund or any other small cap fund, it's essential to do your research and understand the risks involved. It's also crucial to have a long-term perspective and not get caught up in short-term market fluctuations. We'll be discussing more about small-cap funds and their potential benefits and drawbacks in future episodes. For now, let's take a break. We'll be right back with more from the world of stocks and finance on the Riskwiser Zone. Welcome back to the Riskwiser Zone. We're diving into the world of global markets, where turmoil has taken center stage. In recent days, we've seen a significant downturn in stock markets worldwide, and it's all linked to the trade policies implemented by the Trump administration. The story begins with the introduction of new tariffs on imported goods, which has sent shockwaves through the financial market. The S&P 500 has entered bear market territory, falling more than 20% from its recent peak, while the Dow Jones Industrial Average and the FTSE 100 have also taken a hit. The Nikkei 225 in Tokyo has slumped by as much as 7.8%, indicating a global trend of declining investor confidence. Now, let's take a closer look at the reasoning behind these tariffs. President Trump has compared them to medicine needed to fix the U.S. economy, stating that it's a necessary step to address trade imbalances. However, many experts and business leaders are sounding the alarm, warning that these policies could lead to widespread economic damage and even recession. Jamie Dimon, the CEO of J.P. Morgan Chase, has expressed concerns that the tariffs will exacerbate inflation and slow down growth. Bill Ackman, a prominent fund manager, has gone as far as to describe the situation as a potential self-induced economic nuclear winter. These warnings are not just coming from Trump's critics. Even some of his former supporters are now speaking out against the trade policies. As we navigate this complex issue, it's essential to consider multiple perspectives. While some argue that the tariffs are necessary to protect American industries and workers, others claim that they will ultimately harm consumers and lead to a decline in global trade. The impact on oil prices is also worth noting, with Brent and WTI benchmarks reaching their lowest levels in 4 years. This could have significant implications for the energy sector and the broader economy. As we continue to monitor this situation, it's clear that the global markets are facing a high degree of uncertainty. The question on everyone's mind is, welcome back to the Riskwiser Zone. We've had a fascinating conversation so far, exploring the intricacies of risk management and investment strategies. As we wrap up today's episode, I'd like to shift our focus to a recent development that's been making headlines in the world of finance. You may have heard about the US-China trade tensions and the retaliatory tariffs imposed by various countries. But what caught my attention was the impact of these events on the global markets, particularly in the context of superannuation and retirement savings. According to a recent article, the S&P 500 has taken a hit, dropping 17% from its two-year peak. Meanwhile, the S&P SX 200 has fallen 15% since the announcement of the so-called Liberation Day tariffs. These fluctuations have left many investors, especially those nearing retirement or already retired, wondering about the security of their savings. Now, I'm not here to spread doom and gloom, but it's essential to acknowledge the uncertainty surrounding these events. Investment chiefs such as those at AMP and Aware Super are taking a cautious approach, awaiting further signs that the market has bottomed out or that the Trump administration is willing to negotiate on tariffs. It's also worth noting that some retirees, like Gordon Jagger, have taken proactive steps to reposition their superannuation portfolios, reducing their exposure to U.S. equities in anticipation of a potential downturn. While this approach may not be suitable for everyone, it highlights the importance of being informed and adapting to changing market conditions. As we navigate these complex and ever-changing markets, it's crucial to maintain a long-term perspective and avoid making impulsive decisions based on short-term volatility. Super Consumers Australia Chief Xavier O'Halloran reminds us that superannuation is a long-term commitment, and trying to time the market can be a fraught exercise for individuals. In conclusion, the current market landscape presents both challenges and opportunities for investors. While it's natural to feel concerned about the impact of trade tensions on our retirement savings, it's essential to remain calm, stay informed, and consider seeking professional advice to make informed decisions about our investment. That's all for today's Riskwiser Zone. Remember to like, share, and subscribe, and until next time, invest with caution.